going to start like he normally does with all the charts to show this market how it's been moving up. And today was actually not a bad day. Did pretty good on the futures. Got a nice play on NQ, which bounced nicely. But it is a tighter range I found the past month and coming into February. So it's not as huge as it was before for the bigger daily totals. So, Rob, if you want to take over, go ahead.
All right. Thank you, Frank. Good afternoon, everyone. Welcome to another edition of our Wednesday webinar. The person you just heard talking was Frank. He's Stock Guy 22, and my name is Rob, also known as Stock Darts. You could follow either one of us at Stock Darts on Twitter or at Stock Guy 22 on Twitter, and same with the YouTube. And you can also find some extra content from myself at patreon.com/stockdarts if you are ever interested in seeing more about my trade ideas and my trading process. Other than that, let's go ahead and get started. As usual, we're going to go ahead and take a look at the four major market ETFs. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we complete that, we'll take a quick look at the US dollar, how it's affecting commodities like oil, gold, and silver, and then we will move on to the chart requests. For those of you that are in here early, if you guys have a chart request, feel free to put it in the chat already in the questions tab, and let me know if it's a name that you are looking to enter as a trade, or maybe it's a name that you're already in a trade and don't know if you should take profits or stop out, or maybe you just have a question regarding what kind of pattern it's in. Any little bit of extra information that lets me know what exactly it is that is interesting you about that chart, and I'll be able to go ahead and spend as much time as necessary to sort of figure out what it is that you're looking for. Other than that, let's go ahead and get started. We're going to take a look at the S&P 500 first with the ETF SPY. And as you can see, it's been a really strong market since the turn of 2019. And we're reaching a point now where it's becoming a little bit difficult to find trades. And the reason for that being just that the market is so strong and so stretched out that it's not really good risk reward right now. And I spent the last couple of weeks really digging for trades, and I'm finding a few here and there, but not as many as you'd expect with a market that is strong. And I think the big part for that, or the big reason for that, is that of course everything has moved already, and we're reaching a point now where the market looks like it's starting to get a little bit tired. You can see we had a nice little bull flag. We've actually had two bull flags, by the way, because we had this bull flag here right at resistance, and then we bunched up and came up here and really pushed up against this 263 level, which was really key. And then we had that nice little explosion in price all the way up to the 200-period moving average. I think we're reaching a point now where we should be expecting the market to tire out. And the question is, once we hit this new resistance, which we're kind of bumping up into now on the S&P 500, are we going to pull back and sort of fall back and retest some lower levels, or are we going to print another bull flag and just sort of trade sideways for a few more days and then push up past the 200-period moving average and come up to a really, really critical area here, which is this area around 279 to 280. I still feel like that's rarefied air. I don't really expect us to push past that and back to new highs. I think at this point, what we're seeing this year is starting to get a little, I don't want to say out of hand like it's a bad thing, but I think we're reaching a point now where it's going to be pretty hard to continue to sustain what we're seeing so far this year. At some point, we need to find some selling pressure, and we need to really test the bull's resolve more than it's been tested so far. As you can see, if we really go back to it and we figure out, okay, so this was the start of the year, right? And we've had 1, 2, 3, 4 red candles, maybe 5. I'm not sure if this doji counts. And everything else has been green. Everything else has been strong. Like Frank said, volatility has died down, at least intraday volatility. And of course, that's because when you're going higher, a lot of times you have these little candles as you march your way up, as opposed to when you're taking the elevator down, right? And you have these big red candles as the market really struggles to find support. At this point, we finally found some support, and we're just drifting up higher and really almost squeezing with the way that we continue to just push up without any real kind of selling pressure whatsoever. And I think at this point, it would be healthy for us to pull back. And the reason for that being, again, that we want better risk reward as we start to enter new positions and start to take advantage of this change in attitude by the market at the start of 2019. I mentioned a few weeks ago that it really looked like the character of the market had changed and that we could start looking at bullish plays again, and not be quite as defensive or as worried as we were maybe the first week of January or the last week or last couple weeks of December. And I still think that's the case. I think that dips at this point should be bought again, just like they were last year for the most part. And at this point, we're just looking for a better scenario where we get better risk reward and we get higher probability patterns to play out. Anyone that's traded for any length of time knows that when something is up this many days in a row, it's not a good idea to trade just from a timing perspective. Even if the trade ultimately resolves in your favor, you're going to have to hold it while it pulls back because you got in at the wrong time. So I think at this point, if you're looking for charts, you need to find charts that have either lagged behind and are still trading a bull flag like this, and then you got to catch 22, right? Because you have something that has good risk reward, but there's something systemically wrong with it because it hasn't moved up with the market, and that's really where we're starting to find some issues with trades right now. Is that if you're finding something that hasn't broken out, there might be a reason why it hasn't broken out, which is making it difficult to trust that name to eventually follow suit and push higher. So what I've been doing is looking for areas of the market that maybe aren't 100% correlated with the market, that move sort of on their own. And something maybe like the marijuana stocks or something like gold and silver, maybe even some oil-related names that do have correlation with the market, but also tend to move separately from the market when certain themes play out in their favor. And so while we do that and wait for a better situation, the best thing I could tell you is just be patient and wait for a better opportunity, which should come pretty soon. And if not, then do like I do and focus on other areas of the market that maybe aren't that correlated. Another thing, of course, that I do is what I do every single quarter is focus on earnings plays, focus on plain volatility through options. That way I'm not overly concerned with the direction of the market while I wait for it to give me a better situation. Now, we did have a nice situation a few weeks ago when we had that bull flag. And I think at this point we're waiting for, again, either another bull flag or a pullback and a retest of prior support. And I think if we got a pullback down to 264, that'd be a fantastic area to look at buying the dip. I'm not sure if we get all the way there. We might posit to 20-pair moving average. We might just flag here in a very tight range just below the 200-pair moving average. If we do flag just below the 200 and then break past it, I don't see us getting past 279. So I think that that's going to be a really strong area to really pay attention and to start to really unload any swing trades that you've had up to this point. I think that we're still at a point where if you were able to catch any of this swing, whether it's through SPY, whether it's through other names, at this point, you should be trailing your stop upwards and looking for places where you really should be taking profits, right? But ultimately, if we get to 279, that's a spot where you really want to be much more quick and much more decisive about taking profits, because I don't think we push past that level without any real kind of a pullback of stronger substance. And if we continue to squeeze up to that level, that only makes it more likely that when we do hit that level, we'll pull back sharply. So have your fingers on the triggers. And if you are wondering about taking profits, keep an eye on how we start reacting as we start to get to these higher levels. And sooner or later, we will see some selling pressure come in. And like I said before, I'm kind of looking forward to the selling pressure because it'll give us a chance to buy a dip and to buy some better value areas than what we're getting right now. So the key levels on the S&P 500, I kind of already went over them, but just to sort of reiterate, we are at a semi-important level right now, which is the 200-pair moving average, which is right here around 273. If we can push past that, I expect us to probably make a run at 279 to 280. That will be pretty much the ceiling that I expect on price action in the short to intermediate term. I don't think that we're ready to get past that. If we do pull back, this level around 263 becomes a really critical spot. And I really would not want to, I'd consider that the really good buy the dip area, and I wouldn't want us to push past below that. If we fall below that, we'll have to probably come down and test 259, and that's a very critical area. If we come back to the weekly chart and take a look at what that area sort of signifies, that was the bottom of this base that we formed throughout last year, right? You can see that we often found some support levels around 259. Now, there's a lot of back and forth. There's some long wicks that went through there, but the meat of the price action is right around 259, and I would consider that to be the floor of the base that we printed throughout last year. And we don't really want to be below there. If we fall back below there, then that means that maybe that this entire bounce that we saw in January was just a dead cat bounce, and that we're probably going to start heading lower and start testing new lows. Now, again, I don't think that's really what's happening right now, but we always have to be ready for different scenarios to play out, right? And so if we do start to get selling pressure and all of a sudden the bulls disappear and we lose this 258, 259 level, well, then we have to be open to the thought that maybe that was just a dead cat bounce and maybe that the market still is in the ugly place that it was in November, December of last year. And at that point, we should be open to the idea that there's a chance that we continue to head even lower. Now, I don't think that's something we need to concern ourselves with, say, from this week to next week or even the week after that. But it is something to keep an eye out. Now, more likely than not, what we're going to end up doing is spending the next few weeks probably somewhere in this 275, 274, 275 area, and in between there and maybe 264, 265. So maybe something like this, right? As we either build a flag and try to push higher, or sort of roll over and come back and test this breakout area from this bull flag around 274. And again, I think anything along those lines is healthy. I'd prefer that over a run back to 280 at this point, and obviously I'd prefer it over a move back to 258. So ideally that's what we do, is we spend some time in this area and kind of consolidate and take a little bit of time to reset some charts and have them start to give us some more favorable consolidation patterns that are easier to trade than what we're seeing right now. Again, when the price action gets as extended as it is right now, it becomes difficult to trade, even though the market's very bullish, because it forces traders to try to chase this. And that really becomes the most important thing for you, is to have the discipline to not chase the price action. The market right now is trying to entice people to buy things at prices that are difficult to accept. And the reason for that is sooner or later, those are the people that end up abandoning their shares and causing the market to sort of pull back in an even quicker fashion. So at the moment, you don't want to be the ones that are the sort of the weak hands that are chasing the price action and buying it at poor risk-reward levels. You want to wait and be patient for a better spot to go ahead and buy it. Now, could it keep going up from here? Sure. But you can't let that affect you, and you can't let that force you into taking a bad trade. I've discussed this before quite a bit in detail, and it's actually one of the central tenets of my teaching and my mentoring is making money or having the stock go up doesn't make something a good trade, and having the stock go down or against you doesn't make something a bad trade, right? The parameters that decide whether you took a good or bad trade are dependent on what rules you have in place as far as what risk reward you're willing to enter, what your sizing is. And then a good or bad trade is whether you respect those rules, which are what gives you the edge over the market, right? And that's the idea, is that you want to turn the market sort of into your own personal casino, where you're the casino that has the edge and lets that edge play out over time by taking the plays that give you a better chance of winning than losing. And I've seen a lot of traders say, well, you told me this wasn't a good trade, and look, it went up the next day. And yeah, the stock went up, but that wouldn't have made it a good trade even if you took that trade. You would have made money and you would have been happy, but more likely than not, the more often you take that trade, the more it punishes you by going against you than the times that it would have favored you. So at this point, we're at that stage where we need to be patient and wait for a better opportunity. Even if the market it can continue squeezing from here and can continue drifting higher, but that doesn't mean that you should be trying to buy it and chase it, because in reality what you're doing is you're putting yourself in a situation where you're more likely to fail than succeed. So you have to be patient, and you really have to dig through charts and try to find charts that have better risk reward, that aren't necessarily weak, right? You want charts that are either ahead of the curve and are already consolidating, or maybe they were lagging a bit, but they're not in a weak state where you're just buying garbage because it hasn't moved up. you need to find charts. And again, it's a lot harder to find stuff right now that's working, but there are some charts out there. And again, if you're on my Patreon page, you'll see some of the charts that I'm looking at, and it's been difficult. I haven't found that many, but I found a few that I think have been working pretty well for us. And so that's where we stand right now, right? It's going to be across the board, the S&P 500, the NASDAQ, the Dow Jones, the IWM, all are going to look very similar, and all are going to be in similar spots where we need to be more patient and wait for some better probability or higher probability situations. We take a look at the Qs here. And you'll see we actually did something very positive on the NASDAQ, and that was to break through this descending channel, right? This channel was sort of defining the NASDAQ since way back in October of last year. And as you can see, over the last week, we did a really strong job of breaking out of that. So again, this is another really good bullish sign that we're done with this correction that we saw last November and December. Now, are we ready to resume highs? I don't think so. Last year, at the start of last year, I had sort of put out this theory that we're going to spend the next couple of years trading in a broad horizontal range, right? And I thought it was going to be very similar to what we had back in 2015 to 2017. You take a look at, again, we're going to backtrack to the SPY real quick. And you can see, again, we had this broad range, right? We had a really strong market in 2013, 2014. And then we spent 2 or 3 years just trading sideways, right? Threatening to break down, threatening to roll over, and then eventually breaking out and trading higher, right? And we're sort of in a similar situation. That was my theory last year, and it was tested a bit, right? Because we started off the year selling strongly, and then we had this strong rally that sort of made it look like maybe we were going to continue just marching on like we did throughout 2017. But then with the rollover, we actually tested that theory again the other direction by breaking down and trading below that base, right? But we've kind of come back, and particularly when you look at the Qs, that didn't break down quite as drastically as the S&P 500. You can see we're hashing out a big, broad trading range, right? And this is probably going to last all year. Now, of course, you know, that's to predict something, to predict what the market's going to do for the next 10 months. That's not something anybody could do with any real accuracy. And there could be the chance that we roll right back down, or we could go higher. But I think right now, the highest probability scenario is that we continue to trade sideways, and we try to push the boundaries on both sides, but ultimately probably trade within this range. And I will say this, at the start of the year, it didn't look like that. It looked like we were going to continue probing lower and test lower, but we had such a change in character. And I think it became pretty obvious once we started breaking past this 156 area with the strength that we did. We had this flag around 160. We continued marching higher. It started to look like there was a whole different attitude going on. And those of you that follow these Wednesday webinars regularly know that we kind of came to that conclusion pretty quickly, that the market sentiment had shifted and that we were definitely looking at a little bit more of a bullish market. However, that being said, and as strong and as bullish as everything has been here, I don't think that we've reached the point where we're expecting new highs. All I think that's happened here is that we've had a big shift where we can maybe say that we're done correcting and are ready to continue to explore these price points. Could we go higher? Probably. The NASDAQ has a little bit more room to run before it really runs into another major level. I think the next major level is up here around 177, 178. As you can see, there's still about 8 points of upside here, right? You take a look at, we're done with most of earnings season. You take a look at what happened here with Apple. It finally had a break of that downtrend and a really strong move to the upside. You take a look at Facebook and see what it's doing. You take a look at Amazon and what it's doing off of a bad report. It's still kind of holding that breakout. Google, which again, sort of disappointed on its report, and yet it's still moving higher. You look at Netflix and what it did with its report. I would say that the FANG stocks, again, have told us that we're probably done correcting. Some of them are starting to approach some higher levels. And when you see that across the board, it tells you that more likely than not, the rough seas are kind of behind us, and we can start to relax a little bit and start to look at trading in sort of the same manner that maybe we spent last year, right? Looking at bullish plays, not overly bullish, expecting moves to highs, but at least expecting to be able to buy the dip and to continue to take advantage of this momentum that is really sort of taken a lot of people by surprise at the start of this year. Will this be something that lasts all year? No. I think, again, the bulls have not really been tested in 2019, right? And I think that there's still a test coming. And I think how they respond to that test is still the most important thing, as to really figure out whether we are done heading lower and really are ready to trade sideways and possibly even test the top of that range again. That may not come for a while. It didn't come during earnings season, which is pretty critical. And I think at the moment, we're trading with such strength that we shouldn't really expect a strong pullback. Again, ideally, I'd prefer that we did pull back a bit and started retesting some previous levels. So on the Qs, the level I'd like to see tested again is this breakout of this channel, somewhere around 166 to 167. That, to me, would be a great spot to go ahead and test. Maybe test these moving averages as they kind of curl back up over price. And then from there, we at least have a little bit of value that we can go ahead and say, well, we have much better risk reward here than we do trading at highs, right? But that might not be what we get. It might be that we get another bull flag that trades for another 2 or 3, 4 days, and then we try to break the 200-pair moving average and start probing higher. And we have to be ready as traders if that's what ends up happening, right? And continue trading momentum as it continues to push upwards and explore price higher. But ultimately, like I said, I don't think that we are looking at a move back to highs. I think all that we're doing is that I think this strength is establishing that we're done correcting and have at least sort of re-entered the trade environment that we had throughout most of last year. And again, last year was bullish for the most part, but with a lot of breaks and sporadic selling in between. And it's going to be, that's the sort of action that's indicative of these broad ranges. And I think that's going to be the case as we move forward this year, is that we're going to find that there are going to be these spans of weeks to months where the market seems like it's in a bull market, and then there's going to be these times, again, that could last 3, 4, 5 weeks where it looks like we're heading back into a bear market and we start to correct. And that's really what always happens when you have these broad ranges, is you're going to have shifting sentiment quite a bit. And at the moment, the sentiment is bullish, and we have to take advantage of it until the market decides it wants to find buyers again, right? And again, it's sort of the opposite, right? When a market is strong, the market is looking for sellers, and that's what it's doing right now. It's trying to find out where the real supply or the real selling pressure is. Once it finds it, then it shifts and starts looking to figure out and test the metal of the bulls and figure out where the buyers are, where they're waiting and lurking to find value, right? And at the moment, it's looking for sellers, but I think that we're reaching sort of a culmination of that, and I think pretty soon it'll start to pull back and start to test for buyers again. But until that point, we have to sort of take advantage of this momentum and trade to the upside, but only when we get good consolidation ranges. And again, I think at the moment we don't have one. We just have 2 candles that are trading just below the 200 period, so not a lot really going on there. Now, the key levels that we need to look for, I kind of already hashed them out, but this area around 166 should be the first level of support. If we fall below that, then I expect support down here 161, but that would be probably more selling than expected, because that would put us back in this channel, and that could be a problem. Ideally, I think with the strength that we're seeing, I don't think that we're ready to fall back into that channel. So I expect us to hold up above 166, 165, and stay sort of above this trend line. To the upside, well, there's some strong selling spots right here where we're at. You can see this red trend line from way back earlier in last year that is kind of holding price in check right around the 200. If we break past that, there's a couple of stages, but really the next key level is all the way up at 178. And while we probably start to falter a little bit ahead of it, that would be the ultimate ceiling that I don't expect us to pass. All right, now we move on to the Dow Jones. And we can see this similar price action, right? We're just shooting straight up. Let me extend last year's range a bit so we can see all the candles. And again, no selling pressure whatsoever. We already cleared the 200-period moving average. We just went right through it, like spent 3 days testing it and then just broke right through it. And honestly, we are really pushing. I don't even want to really draw this trend line. I'm not sure that this is really that critical, but you take a look at what happened as we started to top out last year. Now, again, this trend line's a little suspect because we did have this sort of top up here where we broke past it, but you can see that momentum started to shift once we hit September of last year, right? And once it did that, we had this certain trajectory that we were testing the market before we really rolled over, and we're starting to come back and test that again. Judging by what we saw out of the NASDAQ, I wouldn't put it past the Dow Jones to break past that, but this might be an area where we stall out. So like I said, I think the market's getting tired. I think that we've reached a point where the market needs to either pull back or trade sideways. And I think it's pretty evident on most of them, right? You can see on the Dow Jones we have sort of that theoretical resistance. Like I said before, with the NASDAQ, that resistance is, of course, horizontal, and it's right here around the 200-period moving average and this red trend line. With the S&P 500, again, it's horizontal resistance right around the 200-period moving average. And so it looks like the market is starting to reach these spots and these pockets where it should tire out here. And I think really the question is, what form does it take once we sort of stall out? And it's either we trade sideways and print a bull flag, or we pull back and test some other prior levels. Now, with the Dow Jones, if we pull back and test a previous level, well, the 200-period moving average becomes a pretty obvious spot to test, right? That would make a move from 254 down to about 250, at which point we could either look at it as a quick pullback or a sort of a broader range bull flag, right? Either way, as long as we stay above the 200, I think that becomes a really good buy the dip area. Even if we fall slightly below it, as long as we stay somewhere in that area, that becomes a good spot to buy the dip. Once we start to see some green, either hammer candles or other sort of bullish patterns forming, and that might be the pause that we need to sort of take another shot at some of these resistance levels that we're actually testing at the moment. If we push past this, well, then I think we can probably hit about 260 to 262 on the Dow. And again, I think that that's starting to get to some rarefied air. If we started to hit that, that would already start to threaten last year's highs, which is a pretty bold move from the markets when you consider how we closed out last year. I don't think we're ready for that, but I've been proven wrong before. And I wouldn't be completely shocked if we did it on the Dow first and really start to probe 262, 263. But again, I don't think that we're ready for that. I think that we need to sort of pause and test the bulls a little bit more than what they've been tested so far. But if it happened, I'd be nice to watch. But again, if we squeezed up to that level, I still wouldn't really be trying to buy it. I probably wouldn't be shorting it either. I think I'd just be waiting for a better opportunity. That's really pretty much it for the Dow Jones. I think it's pretty easy read. If we lose the 200-period moving average, we can come back and test this bull flag that we printed here around 245, 246, and maybe test this level around 244. I don't expect anything below that. Again, you can see all the moving averages are now starting to turn upwards, and things are looking pretty bullish. Again, I think that despite this bullishness, I think there will be a turn where we start to see some selling pressure again, and I think that's going to be the ultimate test as to what we're going to do for the next couple of months, is how we handle that selling pressure. But for now, the selling pressure is completely non-existent. And until it sort of returns, we have to, again, just assume that we have to take advantage of this bullish momentum, but in a responsible way where we're not just chasing price action. And finally, we have IWM in the small caps. And again, you can see it's been very strong. Relatively speaking, still by far the weakest of the four indices. We're still not testing this descending trend line, nowhere near the 200-period moving average, nowhere near even testing halfway up last year's range. But we have decisively come back into last year's base, which is a nice step forward for the small caps. Now, the small caps have been the weakest of the four for a while, and I think it shows that a lot of traders have had one foot out the door for a while in this market, even during its more bullish environments. And so when the market's ready to roll over, we're going to see the selling first in IWM. So if you're worried about the correction, whenever we get our next price correction, if you're worried about it leading to really bad behavior, keep an eye on IWM first and see what it does. Now, ideally, if we are in a much stronger bullish environment, then IWM should not lose 145, right? We shouldn't fall below last year's range. So when we start to pull back, if IWM falls and slices right through that level and starts trading, I would say once there's a lot of room for error here, right? But if it starts to fall back into this 143, 142 range and starts to try to roll past that, then I'd say that we have to worry about the markets across the board. Now, again, it's been pretty obvious throughout the last several years that IWM, even when it crashes, has not had a strong impact on the markets. They've been able to sort of weather the storm and push past it. So even if IWM loses that level, I wouldn't say that we got to stick a fork in the market's back and that we're back to last year, to last December's price action. But it would be a warning sign, and it would force me to be a little bit more cautious with my buy the dip plays on other sectors that I feel are healthier. But it would be a warning sign, and I would be worried about it. But it wouldn't be enough, again, to sway me from trading to the bullish side until I saw the NASDAQ and the S&P 500 start to lose their critical levels. And I think that would be the ultimate key, right? But if you want a quicker warning sign, then keep an eye on IWM because they will be the first to sell off if the market starts to really correct again. Now, you can see there's more room to the upside on IWM. They're still lagging behind. They really haven't tested some critical levels yet. Whether you want to look at them as horizontal levels or as these descending trend lines, there's still room to go upwards before we really stall out. So the market can continue to squeeze here, or we flag and then try to make another move up. As you can see from the last two candles, it looks like we're trying to flag here. And again, really that's the ultimate question right now is we are pausing for a breather, and what form is that going to take? And I know I've kind of harped on it quite a bit, but that's really what we're looking at right now is, are we going to trade for another 2 or 3 days sideways and then push higher? Or are we going to sort of lose some of this traction and come back and retest some of these lower levels? Now, again, with IWM, 147 would be really good because it means that we held the previous bull flag. But even if we come back, as long as we stay above this 146 area, we're good. And if we could push past this trend line, then I think it shows that there's still a lot more bullishness in this market and a lot more strength. So to sort of sum up everything, we're in a much more bullish environment, obviously, than what we saw last year. I think our attitudes as traders have to change from maybe the defensive posture that we had at the start of this year or the end of last year. And we need to be a lot more aggressive about taking advantage of a market that's this bullish, but we need to do it in a responsible manner, right? And so at this point, what I'm doing personally is I'm still combing through a bunch of names looking for a stock that maybe is trading in a healthy manner and going from there. So I'm going to give you one example. This is one of the trades we shared on our Patreon page. And it's working okay. It's not working great. There are other trades I have that are working better. But I think this fits the mold of what I'm trying to explain a little bit better, right? Which is, it's a name that's trading. It was trading in a nice range. It broke out. It was actually doing pretty well today. It was up to about 16, and yesterday as well. But more importantly, it's in a sector, biotech. Biotech. It's actually a marijuana stock, and it's doing its own thing, slightly different from the market, but it's still giving me a chance to trade a bullish name that's not overly extended or overly stretched out. There are others like Canopy Growth that are doing their own thing. And again, this one in a little bit of a different spot. You can see it's pulling back already. You could say that this is maybe ahead of the market rather than lagging behind. And I'm not saying to trade this name, but I'm just saying what you want to do is explore an idea and look for something that is not necessarily going to follow the whims of the market, right? Because if you're following what the market's doing right now, then any name that you trade is going to be trading very similar to the market. Now, you could trade something like Facebook, of course. You could trade something like Google, and but the thing is, they're mimicking the market, which means they've already moved up and are sort of stalling out. And at this point, what we want to do is, I want to trade these names again once they set up better opportunities. And at the moment, we're not getting those opportunities, so we have to find the opportunities in the names that we can. And that's what we are. That's what we're doing. We're just being patient, and we're trying to find opportunities while we wait for the market to settle up and give us a new bull flag or a triangle or something that tells us that we're consolidating and getting ready. And when we're ready to move again, it'll be obvious. Other than that, let's take a quick look at the U.S. dollar. We're going to look at oil, gold, and silver, and then we'll move on to the chart requests. Those of you that are here, again, I'd love to see a couple chart requests at least to sort of give us something to explore. A lot of times when someone has a chart request, it actually opens up discussion that could lead to other charts and other trade ideas that work. So if you guys have something, I'd love to see what you're working with and what you're looking at. Now, here's the UUP index. And again, the US dollar has been in a weird place for the last few months, right? It's losing momentum, but it's still struggling to hold on. You can see this trend line. We lost this trend line. We're sort of trading underneath it and struggling to sort of not really roll over. We've had a nice 5-day run off of the lows and are coming up into some critical resistance again around the 25.65 level. And you'll see it as we go through the individual crosses that there's been a lot of fluctuation here. If we look at the euro versus the US dollar, you can see that and again, this is a level we've been looking at for a while now, this 113 level. It keeps fluctuating back and forth between bullish and bearishness. And the euro had a real strong move again, and it sort of failed it. And the US dollar, again, this is inverse because it's priced in euros. And the US dollar's come back again. So I'd say overall, again, this is neutral because the euro and the US dollar can't get out of each other's way and continue to struggle at this price point. If we look at the US dollar versus the Canadian, we can see that the US dollar had lost a lot of strength and over the last few days has finally found the bottom and is trying to bounce again. Now, I'd say overall, the trajectory is still sort of down on this, but it's trying to find and it's trying to at least move back to a neutral range where it can start to trade sideways. And I think that ultimately this price around 130 might be the spot, although it might come all the way down to 128 or 129. And I'd say at the moment, short term is bullish, but the intermediate to long term, I think, is still a little bit bearish on here. And if we look at the U.S. versus the yen, you can see that the U.S. dollar has actually started to pick up a little bit of strength here and build out a base, right? So what we're seeing here is the U.S. dollar trying to hammer out bottoms after dropping, right? And when we see that, you'll see that gold and silver are starting to sort of stall out after the strong move from their last run. Now, this has actually been pretty strong. Gold in particular has been moving pretty well. And if you look at some gold miner names, again, one of the theories or one of the things we're doing is we're trying to find names that aren't correlated to the market, right? Here's another one, Kinross Gold. This is another one. I had this on my Patreon page. We've discussed this one in particular in several Wednesday webinars or other gold-related names. Look at these patterns. You can see they're not that correlated with the market, right? And they're clear, they're obvious patterns, they're easier to trade. And what we have to do is we have to find trades like this that aren't stretched out and don't have the risk-reward problems or issues that the overall markets have, right? And what's interesting is that you can see these gold names, right? Let's just look at GDX. Have had a lot of momentum and have been trading well, despite the fact that the U.S. dollar has sort of started to bottom out, right? And these names are still doing well. So I think gold and silver, they're flagging now, and there's a chance that if the U.S. dollar rolls over again, these things continue to explore higher. You take a look at a weekly chart, you see what GLD has done, and there is room to the upside, right? Ultimately, if we really want to hash out what range GLD has had over the last 3 years now, 4 years, and you can see it's traded between about 110 and about 130. We're not really up to 130 yet, so there is more room on gold names right now than what we're seeing. Does that mean chase it? No, but when you see patterns like this, these consolidation ranges, you have to go and find gold miner names or silver names that are mimicking this pattern and trade them as they move off. Like KGC, once they break these patterns, then you have an easier trade that you can take advantage of as it breaks out of these consolidation ranges. Okay, And I think gold and silver right now are actually not too shabby as far as names you can look at. But you have to dig through because they don't all behave like this. There are different names that are doing better than others, and not every single name is trading quite as cleanly or as easily as what we're seeing on some of these gold miners, right? I don't want to make this a whole discussion on gold miners, but if you dig through, you're going to find some names are doing better than others. And then finally, we have oil. And oil actually is not looking too bad either, right? You take a look at what's going on here. You look at this trajectory. It tried to break above 54, which is a critical level again. If we look at the weekly chart, you see what the range that we spent, again, 4 years now. We did break out of it, right? But we ultimately rolled over real hard and came right back into it. And at the moment, gold is trying to, oil is trying its best to break this 54 level. It's struggling, but if it does break it, there's some bullish momentum on oil names. Now, again, what makes this such a nice pattern is that you could trade this in both directions, right? If this breaks higher, you have a really good bullish trade. If this rolls over, you have a really good bearish trade, right? So you can actually trade this in either direction. I think that you're fine in either way. Because there's a strong case to be made for the bears that you're at the ceiling. You have this strong trend line. It already tried to break out and failed, so we got a failed breakout. And once it breaks down, that is a beautiful bearish play, right? You've got a failed breakout. You've got a break of a trend line. You've got the top of a ceiling of a range, and that should lead to a move all the way back down to 42. However, it's also a good bullish play in that you have this nice consolidation range and you have this critical level you're trying to break out of. It already tried once, and if it does a second time, it probably favors a good move. And so this could play in either direction. And again, you don't have to trade oil futures or USO, but you can look at oil-related names that mimic this pattern very closely. And one thing I do want to point out is there have been some oil names like ConocoPhillips or like Exxon that have actually already broken out and have done a pretty good job of starting to build up on some bullish momentum and are now trading and printing new bull flags as they try to break out. So this is another space where it's not 100% correlated with the market and is giving us better risk reward right now. Now, are they obvious bullish plays? Not always, but at the very least, we're trading something that isn't necessarily going to mimic what the market is doing, which means that we can go ahead and maybe trade it off of a different sort of time frame and different sort of behavior pattern than what we're seeing in the overall markets. And so I think oil, gold, and silver all actually are providing us with decent opportunities right now. So Chris, you have one also. You want to look at Suncor. We could look at it both on the Canadian exchange or the U.S. exchange. And this is another one. It had a nice flag here. And it just broke out. Now, it actually lost a lot of that today at the open, but it's gotten it all back right now. And yeah, this is another one. It's very similar in that it's trading in a different sort of pattern than what we're seeing in the markets, but overall is trying to make its way higher, very similar to what we're seeing on CL. And there is room for this to go higher, right? If we take a look at where we stand and what we're looking at. I will say this. You've got that overhead ceiling coming up, right? So that's something to keep in mind or keep an eye on. And once it breaks that, it probably has a clean move all the way up to 46, and then from there we'll see what happens past that. Is there another level here? Yeah, we're fine with that. All right, we don't need to see that. Yeah, so that's Suncor. That's the Canadian one, and I mean that looks fine too, right? Let's see the U.S. chart's going to be the same exact thing. Actually, you can see I've charted the U.S. one before. Those of you that are regulars here, we looked at this in December. Frank and I discussed bottoming plays on oil. Frank was pretty bullish on buying some of these. He thought that there was good bottoming patterns, or that they were all on good support levels. And as you can see, ultimately, they did bounce, right? Those of you that are regulars, hopefully, maybe took advantage of that. a little better than I did. And as you can see, all of them, again, from December, which is when we drew this baseline here, was when Frank and I were looking at it. And you can take a look now. They did head lower and came back up, but ultimately all of them bottomed out eventually, and started to make their way higher. And I think that they're in an intermediate stage here and trying to explore even higher. So just a sort of, I'm not saying that oil, gold, and silver are the best trades to take right now, but I think that they are in a good place where while we wait for the markets to give us better risk reward, these are sort of the idea you want to look for. Is you want to find different sectors that don't mimic the market 100% and are giving us bullish plays. And I think all of these, they're all in bull flags, and if they resolve higher, can give us some nice momentum plays to the upside. All right, we still have about 10-15 minutes. Anyone else have another chart you're looking at? Again, don't be embarrassed or don't feel like you know the charts that you're pointing out. It doesn't even have to be a trade. It could just be a question on a chart. It could be asking, oh, you know, like, what do you think about this? What does it look like? Anything along those lines to just kind of spur conversation in a different direction. Wes, you have a question on Intel. You're up 5 points. Should you take profits? That's a good question. That's pretty good, 5 points. So you got this. Did you hold it through earnings or did you get it right after earnings? And have you taken any profits? There's actually kind of a mixed answer for this. All right, so here's the thing. It actually just broke out of what I would consider its range, right? We had this descending trend line, right? We had this downtrend. It tried to break right at this level, right? Right around $50, right? You can see it broke out, failed, ultimately rolled over to close out last year, came back, and broke that downtrend, right? And then as it broke the downtrend, you can see we traded for the most part between 46 and about 50. Did dip below that quite strongly, then came right back up, and then recently had a nice move through earnings, right? You had it before earnings and you held, and you haven't taken profits yet. Okay, so here's the thing. I think that this is pretty bullish in that this is a strong, important range, right? And it just broke above it. However, this right here is not something that's that appealing to me right now. If I were you, and the way I like to trade to begin with is, in a situation like this, I would want to hold this because I think that this is a pretty bullish breakout, but I wouldn't want to give up this entire move if this rolled over here. So I would probably close out. Personally, I probably would have closed out half of my trade over here, as it dealt with this 49.50 area. It's just the way I normally trade. I find one of those like real key changing or turning points in my trading career was once I really took advantage of scaling out of trades. I found that if I take a trade and once I reach a certain level of resistance, I close out half my trade, that it lets me trade the rest with a much easier comfort level where I could trail a stop because I know that I've already locked in some profits and that I could hold it, you know, with a much more comfortable sort of emotional state, right? So personally, if I was taking this trade, I would have closed out a portion of it, whether it's a third, whether it's half, whether it's 2/3. Each trader is different, but I would have closed out a part of it here, and then I trail the rest because, again, I think ultimately it broke a key range, right? But I don't like these tweezer tops here that we're seeing, these two wicks, showing some selling pressure coming in. Now this ultimately could turn into a bull flag, right? Which is what we're seeing across the board in the markets, right? And this could ultimately turn into a pattern like this. So I wouldn't want to close out my whole trade just because of 2 candles with some selling wicks. Because again, it broke through the 200, it broke through 50. It really cleared a pretty important transitional area here. And I think ultimately that's bullish. But at the same time, I feel like the market is due for a pullback or correction. Even, I mean, not a serious one, but at least like I said, I think that we need to test the sellers a little bit, and I think the market's getting a little stretched out. And if that's the case, this thing could pull back, and it ends up that you panic and close at a lower price because you don't want to give up all 5 points back, right? So what I do in this situation is I'd close out. I almost always close out half my trade. I move my stop up to whatever my entry was so that the trade never goes against me. And then I hold the rest and look for a longer play. Now, again, depending on how many shares you own, you can also sell calls on this, right? Not sure how big your position is, but you can always look at maybe selling 52 calls, right? And taking in some extra premium on that while you wait for this thing to sort of build up some pressure and continue to climb higher. But I do think ultimately that this is a bullish pattern, and I'd like to see it go higher. But I almost never let a trade go through all this without taking some partial profits just to make it easier for me to manage it the rest of the way. Okay? Now, if you only have one call, I don't know how you traded it, but if you just bought one call or something, well, then that becomes a much tougher choice for you, right? In that case, I might even turn it into a vertical spread at 52 and then maybe take in some premium that way and lock profits that way. But if you bought shares, I would maybe close out half and at least lock in that 5 points, and then let the rest do its thing as it hopefully makes its way up to 52. Hopefully that helps, and hopefully maybe that jives with what you were thinking. You're a regular, and I know you tend to have good trades, so I'm sure you're managing it fine, but that's how I'd manage it. All right, we have time maybe for one more if anybody else has a question. All right. Well, I guess that looks like it for today then, guys. I want to thank you guys for participating and for coming in and attending our Wednesday webinar. Like always, if you guys have other questions, maybe you don't even want to ask the question in a public forum, you'd rather ask me in private, you can always join Frank and I on our Discord channel and ask us questions there. You can email me. You can find me on Twitter. You can message me there. We're always willing to help out. And so if you guys see anything different in the markets that you're curious about, go ahead and ask us there. Other than that, hope you have a good rest of today and a good rest of the week, and we'll meet again next Wednesday.
Have a good day, Rob. We'll talk to you later.
All right.
Thanks everybody for joining us today.